All right, what's up, guys? Welcome to the Nashville Entrepreneur Center. Thank you for being here. If you would have told me that we would have a completely full room for a panel about a nerdy topic like equity, I would have not believed you. So this is really cool to see how many people showed up for this. I think it's really cool and interesting, but just exciting to see that so many other people do. My name is Zap, Z-A-P. I'm a contractor at the Nashville Entrepreneur Center focused on capital. So what does that mean exactly? We at the Nashville Entrepreneur Center really want to educate founders about the capital raising process. And so that looks like simple things like going over pitch and deck, talking about equity, talking about deal terms and structures, talking about how do you go raise in the market, like what metrics do you need to hit to be investable, things like that. And then we're able to access awesome experts like these guys to talk about it too. So I host sort of capital office hours, Tuesdays from 2 to 4 virtually, and then Thursdays from 12 to 4 in person in my office if after today you want to come talk about some stuff you're thinking about with your business. These are the real experts behind me. I'm so stoked to have them here. Let's give them a big round of applause, and then they will introduce themselves.
All right, so first things first, give some introductions, just very briefly. And when she says experts, by the way, she's referring to these three. I'm excluded from that. I'm the moderator. I'll give a quick intro, and then we'll go on, move around the circle. So my name is Brian Dailey. Thanks for coming today. I started a company with this gentleman here in 2011, and we sold it in 2022, worked together prior to that and after for a little while. So stuck with him for 13 years or so, also have a lot of history in startups and healthcare in particular, and I'll be moderating this. Jason?
And his name's Brian Dailey. I'm Jason Moore. I had the pleasure of partnering with Brian Dailey for 13 years on a company called Stratasan. We were actually the first company to move into the Entrepreneur Center when it first opened on September 1st of 2010. That was down on Broadway, right next to Acme Bar. Then they moved into this very, very nice location after we were already gone. It was pretty nice over there, but nothing like this. So we started a company founded in, like I said, 2010. We started working on 2010. We really consider May 18th of 2011 our origination date because that's when we got our seed capital, which is kind of apropos to this conversation. But yeah, that's it. Jason Moore.
Go Dogs. Hi, my name is Peter Swan. I'm the CEO at Gust. We are basically a distributed entrepreneur center. We build software and services for entrepreneurs, founding companies, and managing equity, and the accelerators and investment groups that fund them. I've got roughly, I think, 15 years of startup experience. Spent the last 10 at Gust and have kind of the unique path of starting as a developer and becoming the CEO of a company over the course of a decade. I work in this stuff every day. Hopefully I can answer some of the more esoteric questions and help you feel better or arguably worse about equity. But happy to be here. Thanks, Haley.
Hello, is that working? Hey, my name is Mike Rosengarten. I'm new to Nashville, only been here for about 4 or 5 years. So hello, and if you're new, come find me. I'd love to show you around and what I've seen. My background in entrepreneurship is I started as an engineer, worked at a couple companies, got a bunch of equity worth nothing, and then eventually started a couple companies. Some sold for a couple billion, some sold for a couple million, and got to see kind of what happens with the cap table and everything related to it. So I'm here to represent the entrepreneur's side view of it.
Cool, thanks. So I'll let whoever wants to take this question first take it, but just would love to get a very high level of what equity is and why it's important.
So equity is essentially ownership in a company. And the reason it is super important in a startup company is because you are trying to assemble a whole bunch of people to accomplish something that is on paper impossible. And you have no money. So the way that you incentivize them to actually accomplish this, besides having an amazing mission and doing the impossible, is giving them a piece of that company. Even if it's small, that will hopefully result in a large windfall for them 10 years down the line if things sell for multiple billions of dollars.
Cool, thanks. Anybody else want to add anything to that? No?
Nothing to add.
Okay, that was a pretty comprehensive, succinct answer. Thanks for that. So if you're thinking about equity and you're talking about people that you're going to distribute that to, I assume it's not just co-founders, right? It's other things too. What kinds of equity have you seen given out to folks? What kinds of folks have you seen receiving equity in an early stage company?
Can we get a show of hands real quickly? As Zach mentioned, like we're all kind of surprised about how many people are here. So it's an interesting topic for different reasons for different people. So show of hands, the interest level for this particular topic is because you have started a company or are going to start a company and you're wondering how to distribute your equity, or you're interested in, so we'll start with that, and then the second hands will be you just like the startup scene, and if you do go into the startup scene as an employee, how you would want to negotiate that. So who's here as an entrepreneur looking to start a company or has started looking to distribute? So that's more than half.
Dang.
About half. About half. And then just generally interested in the topic, haven't started a company. Okay, so about 2/3 to a third. Okay, so that helps. What was the question? I'm not. Oh, by the way, Brian's the reason why Stratasyn was successful, like 100%. I legit, when we were standing here before the show, I was like, man, I was surprised you didn't send a list of questions for us before. He goes, I did. I sent a Google Doc and, like 2 weeks ago. And that, for the people that worked with us, that's just par for the course. So.
Yeah, so the question was, what kinds of reasons would you have to distribute equity early in a company beyond just a co-founder?
Sure. I mean, there's a lot of different types of structures for giving out equity. There's like advisor equity, there's employee equity, but I often think about, kind of on that first question, the value in equity is kind of a deferred satisfaction or a deferred like lump of money that has a lot of tax advantages. And so I think there's a lot of things you can do with equity for that reason. And so in the really early days, I think it's important to give your first 10, 20 employees a lot of equity, not be stingy, and have them have a lot of upside. I think there's also kind of another side of this is, do you give it to advisors, to your lawyers, and to other people as a means of deferring some payments or whatever? So I think there's a lot of different types of equity you can give out. It can be tranched in different ways, and as long as you have a framework, that's a good thing. So I would definitely encourage a framework for it. But to me, it's really about aligning interests. And so everything about giving out equity to every single person, how do you align that interest? And that interest can be aligned in a lot of different ways of like, what's the vesting schedule? Is it over 6 years, 10 years, 3 years, 4 years? Employees, advisors, board members, they all have different packages and different schedules. And then how do those things kind of align back? And if you can find alignment, equity's great. I think sometimes cash is better. It's more transactional, and there are certain kinds of employees and advisors where actually cash is much better. Because the other side of equity, I'm curious, raise a hand, how many of the people who are entrepreneurs doing a company are Delaware C Corp? Yeah, so thing about, yeah, I'll get to vesting. But there's the dark side of equity. Once you give it out, you've given it out. And if you're a Delaware C Corp, there's a lot of rights to an option holder, and it can be very hard to claw it back once it's vested. Versus if you're doing what like OpenAI is doing with profit interest units, where you're still an LLC, those are easy to claw back, and you can just cancel them at free will. A lot of private equity is structured that way. So how you issue it, kind of who you give it to, what clawbacks or protections it all has, I think is all very subject to who's receiving it and how that business alignment's there. The short on vesting is typically when you issue out stock options, it's the right to purchase. You'll issue it over a period of time of 4 years, and maybe you'll say every year you get a fourth of that amount that we set up front that you can then exercise and then become the owner of it. The standard vesting schedule is a 48-month where it vests monthly, but the first 12 months come in a lump sum in month 13. So they call that the 1 and 4. But like at all my companies, we do 5-year vesting, and we've moved most of our vesting schedule to 6 years. 4 years made a lot of sense. When companies took 5, 6 years to IPO, we're now seeing companies like one of the ones I'm in, year 18, still hasn't IPO'd, still going. And so again, once you've given out equity, can't really get it back. The only thing you can do is issue more, which reduces everyone's current holdings down. So
Yeah, so I'm going to touch on a couple of things you said there. What I'm hearing, the question was, who's a recipient of this equity? It's not co-founders. And what I'm hearing you say is it's a tool used to motivate people, give them skin in the game, that you want to have long-term interests in whatever your enterprise is, right? So you want them there. If it's a cash transaction, maybe it's something short-term. I need this now, and then our relationship is kind of done. But if I want to have a relationship with this person long-term, whether that's an employee or an advisor or whatever the case is, then equity might make sense. Is that a good summary?
Yep, totally. Yeah, sales coaches, consultants. I love to just pay cash.
So I'd love
You
to
know what you're
hear
getting.
a little bit more on the downside of issuing equity. You talked about that it's hard to claw back. Why would you want to do that? And what other situations maybe, and this is answerable by any of you, are
Oh yeah,
downsides?
a lot of fun ones here. And for the context of this, I'm going to assume we're talking about common stock. In ownership of a company, there's typically two classes. I've always issued three, but there's typically two classes of stock. There's common and preferred. Preferred is typically purchased. Common is issued by the company for compensation, essentially, or effort, or whatever. I typically issue a founder class as well, which is a common stock that has information rights, so it's valued a lot more. Downsides to common stock come with information rights. Some companies aren't careful. They go issue a bunch of stock out there, and somewhere in that stock agreement, you can ask for information about the balance sheets or whatever. So depending on the type of stock you get, and I've seen less experienced founders issue options that when exercised end up having more rights than they should. That's one issue. The second issue is when you want to actually transact. Let's say you want to sell your company. Every person who's a shareholder technically has to vote on that. And we just went through a sale earlier this year. One of my earlier companies is a $1.8 billion acquisition. And in this acquisition, there's a thing called 280G. And 280G is a thing called a parachute payment. And this states that anybody who's part of the acquisition that's going to get 5 times more, I think it's like 5 times more than their average take-home compensation per year, has to be you have to put them in their own schedule and circulate that information for approval from your common shareholders. If your common shareholders are employees, for example, and all of a sudden you see that your top executives are making hundreds of millions of dollars in this acquisition, that could be pretty demotivating. And you may not want to go along with the acquisition. And if you vote no, which you have the right to do, you can blow up the 280G process, which can delay the acquisition, which could in theory blow up the acquisition. And 100% I have seen this happen on 280Gs because you have to disclose it to every shareholder. So that's like just one real example where the top compensated person's getting so much money as part of the acquisition that it causes a shitstorm amongst the common holders who are employees who maybe work 6-7 years and are looking at getting 20 grand, while someone high up is getting 15 million. So
I think that's a really important thing to note. When you're giving out equity, you're giving it to people who are collaborating on your company. Fundamentally, you are giving them ownership, which gives them some visibility into the collective whole that you're building. And as you build different classes of stock, these people have different rights associated with their role. You want to make sure that those things are aligned. Just remember, your equity holders are there. They are part of your company, and they will, by the very nature of what they're doing, put pressure on its governance. That is literally what the ownership in the company is for.
I just share one example because I think I watched this by a CEO in his booty. He sold his company went to sell his company for about $14 or $15 million. They had been in business for 5 years or so. And he had to disclose all this stuff in the acquisition. Well, part of his earnout, and so were many of the other employees, part of their earnout after the acquisition, because whatever price tag you see on a news article is just nonsense. The actual deal terms are often very complex. And in this case, 50% of the leadership's compensation was tied to retention of employees post-acquisition. There's typically a 12, 18, or 24-month period where you want to retain these employees. They have all the knowledge. They're the ones that built it. And wasn't able to retain the right threshold and ends up losing half of their entitlements or earnouts. And so these are examples where this level of information it can be the double-edged blade of giving out equity to a lot of folks who may not also understand all the impacts in an acquisition state.
So if you're a little bit dizzy from all of this, I think the number one piece of advice is to get an attorney that specializes in building the articles of organization for your company and especially this, especially around options grants, equity, anything to do with equity. Do not use your friend or a recommendation from someone that does not specifically work in this particular area.
So no chat GPT?
You can ask ChatGPT who to call.
It's ChatGPT Esquire.
There are really great attorneys here in Nashville. We're really fortunate to have the people that are here, independent, large firms, the Entrepreneur Center is connected to a lot of them. But I mean, that's the number one piece of advice I would have for the whole talk, is to make sure that you have a competent attorney with your best interest. And it's not just at the beginning. We did paperwork at the beginning. Should have had a better attorney. We had a little bit onerous terms at the very beginning. Then when we did a full buyout and growth round in 2019, we had a much more competent attorney, but it's also important that you get your own personal attorney. So because the attorney that's representing your company is not representing you. So definitely get a secondary attorney just to make sure that they're reading the documents for you specifically. You can get advice from them, and they'll say, "Hey, this isn't legal advice. I'm here for the company." But make sure you're covering all your bases, especially on downstream transactions for you personally and for your company. That's my I may not say anything else.
Well, to that point,
also
you can also come talk to us for a lot cheaper than an attorney, and we'll at least give you an idea of where the pitfalls are so that you understand when it's a good time to tag folks in. You do absolutely want a startup attorney, and I think you made a huge point that people don't often think about when they go to start a startup or differentiate it from starting an LLC. When you create a Delaware corporation, you are creating a shared enterprise. It is no longer about you. It is about building the company, and you are secondary, and you are participating in the company like everybody else who is an equity holder. So when you go through a transaction, the company's lawyers are fundamentally not representing you, and you have to make sure that you understand how your rights and obligations to the company function separate from the actual function of the company itself. And to bring all of this back to the beginning, because I think if you get to a point where you're going through a transaction and being acquired for multiple millions of dollars, you can abide a lot of inefficiency at that point. And you are very, very lucky to have gotten there. And yes, you should have a good understanding from day one how this stuff gets built. But going back to the very, very beginning, when you start this shared enterprise, usually you're going to have that class of common stock, and that is going to be distributed to the people founding the company. The share price is going to be super low. It is the most tax-advantaged vehicle to give people equity. And what you want to do then is make sure always that you have vesting attached to those grants for anybody who's coming in. And the vesting, like Mike mentioned, the totality of that vesting schedule should match the length of the relationship you intend to have with that person. And the cliff that you put on it is your evaluation period with them. So if anything goes wrong or doesn't go to expectations before that cliff, you can break up with them and all of that equity can come back. And then once you start to actually accumulate value in the company and get more people involved, that's when an option plan starts to come into play, when it's too expensive for people to buy in, and you get to this option level, and then they have the option to buy shares instead of buying it outright. Same stuff regarding vesting applies. Once you start interacting with investors, then you're going to create preferred shares. And those will have different rights and preferences, but they will become part of the totality of your equity structure, and things will kind of build along from there.
Working from both sides of the table too, as the entrepreneur, or if you're joining a company offering options, one thing to remember too is options can be granted throughout your lifetime with that person, throughout that relationship. So as an entrepreneur, if you have someone asking for more percentage, that will definitely change later. You can offer a certain grant today, performance grants later, or you can revisit it. The other side of that is, and the reason why I thought of it is, we had many employees at Stratasan for a decade or more, and the first grant we gave someone was not the second or third. There were several grants that certain people got throughout that time, so they continued to grow with the company. So you don't have to worry about getting it perfectly right the first time, and if you can get an agreement with the other person, with the employee coming on board, to lessen it early, you can always add later. It's really hard to claw those back, if it's inappropriately large at the beginning. So kind of continuously think about that. Just like in compensation, if you give somebody a $100,000 salary, it's going to be real hard to get them to 80. If you get them to 80, it's very easy to get them to 100 later. So use equity in the same kind of motion that you would that cash.
Agree. Because we went to the dark side of like issuing equity, one thing I will say is these are all solved problems. Like all these things have been figured out, and frameworks for issuing have been solved. There's there's 10,000 blog posts probably on various topics of equities, how to issue to employees, how to issue to advisors, or when not to. And I would just say either asking someone up here or finding those resources online. There's lots of frameworks. The earlier you do a framework, the better, because at least you're consistent. Consistency is the most important thing I can stress about having any type of compensation plan, whether it's cash, 401ks, perks, or equity.
Yeah, 100%. Just a couple quick notes in terms of continuing to compensate people with equity. Do have an understanding as your company gets more valuable and that strike price goes up, there is a change to the potential upside for them as well. So you do want to be conscious of times like fundraising events where those inflection points will happen to make sure people are on the right side of that line to compensate them or incentivize them appropriately. And now I forgot. Oh, yes, it's mostly a solved problem, but taxes are still a huge pain in the butt and a huge way that people who receive equity in companies get bit. So all of the structures are there. The taxes are solvable, but still a pain in the butt in a variety of situations. So have a decent grasp, or at least plan to get a decent grasp on that.
All right, I want to ask you, because you see a lot of these. I've seen a couple, but you've seen hundreds. Like, what would you say is the one or two biggest tax things to look out for? In whatever context he said, tax is really tricky.
So
it seemed very ominous.
I think the biggest thing for people who are starting companies now, file your 83B elections. It is the most common one we see at the beginning. An 83B will help you essentially minimize your income tax burden on your founder shares of common stock, or really any stock that's going to vest, but most commonly that for founders. File it. There is a hard deadline on it. It is very hard to get around if you miss that deadline. That's one of the biggest no-brainers that people miss. And then I think the rest of them are difficult because they don't actually matter until something good happens. And it's really frustrating. Nobody thinks about exercising their options until they leave a company. And at that point, if the company has done well, even if you have tax advantaged options that have vested and you go to exercise them all at once, you end up with a large cash payment, which maybe you have to get a loan against. You end up with a huge AMT bill. So just generally, if you are at a startup or you have equity in a startup and it is doing well, which as an employee of a startup or somebody who's starting it, you are responsible for making sure the startup is doing well. Understand what that means and start to develop, if you have options and exercise strategy, get an accountant. It is worth it to start that process and have somebody walk you through it.
Second bit of advice, get a good CPA. So attorney, CPA, and tell them about these things, right? So as you mentioned, there's a hard deadline. Is it 60 days post-issuance? 30?
It depends. There's qualifications.
Look it up, talk to a CPA. But the point is when you have a lot of flurry of starting a new job, this is probably not your number one thing, or if you're an entrepreneur and you're starting a company, this is probably not something that's going on your mind. So, once again, find a good attorney, find a good CPA, and keep them on your team. Treat them like team members because they are, and they don't know that you don't tell them, right? So keep them informed of these things, and they can tell you about these things. A good CPA that works with a lot of startups will absolutely be saying, hey, I'm not saying, hey, have you done this? I've already filled this form out. You need to sign a DocuSign and be done.
And if you're building a company, please encourage your employees, if it's really cheap, to at least explore 83B. You can't make their financial decision for them, but there's a window on it, so have them look at it. And if you're on the Carta platform, Carta is a one-click to enable early exercise. And just to say what an A3B is in case people don't know, it's a piece of paper you send to the IRS that says, I exercised my stock, whether it's vested or not, doesn't matter. I exercised my stock, I've purchased it, or at least the right to own it as it vests. Here's like the picture of my check, here's the amount, here's the price per share, and then you send it off with a little envelope that is pre-labeled to come back to you. They stamp it, they send it back, and now you have basically your point of sale, or like your proof of sale or proof of purchase. And the reason this all matters is merely to start your long-term capital gains. And then if you bought this stock early enough, before the company's worth about 50 million in assets, you start another thing called QSBS, which I hope is still around. Every other election, someone tries to get rid of it, but essentially it is the thing that says you do not pay federal tax if you've held this asset for more than 5 years. And like I joke that for the 1031 real estate exchange, it is the thing that matters the most if you're building a company and you're the first 20, 30 employees and your stocks can be purchased before 50 million in assets. It's QSBS and 83B. These are the two, in my opinion, the most important things if you're joining early or you're starting something. And then helping your early stage employees think through this because it's a very, I'll share one little like other dark side of this. Not doing this as an example. If you have a co-founder and you get offered $6 million to sell your company and you've only raised $1 million, and this could be really life-changing money, one of the challenges, let's say you've early exercised and held your stock for 5 years, but your co-founder, they didn't send it off. They're off in La La Land. 5 years, 6 years later, you're going to sell your company, and you're looking, because you live in Tennessee, the amazing state, you're looking at paying zero tax on your share of that 5. So 2.5 million is going to roll to you, let's just say. But your co-founder, they really wanted to, move back to Southern California. They didn't do their 83B, and they're looking at a 56% tax bill. And then also because it's over $1 million, they're probably looking at a rich person's tax. So they're looking at 57% tax. The math for them on selling a company 4 or 5 years, invested is very different than the math for you. And this starts to create tension where deals fall apart, where you don't sell, but now there's bitterness. There's a wedge between you. As an early stage investor, 50, 60 companies I've invested in at seed or pre-seed, this has on a single hand has happened at least 3 or 4 times. The alignment even amongst founders when they screw up equity, it gets really messy really quickly because someone, just throws up their hands and walks away. Well, that was your CTO. Okay, well, you're building a technical product and you're so small that maybe you can't backfill that role fast enough. So, and they're walking with 20% of the company. So anyways, these are the reasons you hear people harp about these is because nobody thinks about it until 5, 6, 7 years later, and that's often, there's no way to rectify that. So.
Yeah, and it's tough because it only starts to matter when things are really good or things are really bad, and those are the points where you don't want to be delving into like the minutia of this. And a couple quick points on 83B and QSBS. 83B isn't just the line in the sand to establish the price for early exercise. It actually has income tax implications. So if you have shares that are vesting, by default, the company can claw those back. So the IRS looks at that and says, oh, there is a good chance that these are going to be forfeited. So we're not going to count them as income yet. So if you think about a founder grant at the very beginning of a company, the shares are going to be worth effectively 0. Hopefully, 2 years later, when you're vesting some of those shares, they're going to be worth significantly more than that. If you don't file your 83B, the IRS is going to look at that tax year and say, oh, the spread between what you bought them for, 0, and what they're worth now, a lot more, is quite a bit. And we are going to recognize that as ordinary income this year. And the whole game with equity is to not have to pay income tax on something that isn't fungible or liquid. That's the entire piece. So there's a big income tax thing with 83B, and then there's the whole QSBS thing, which is your capital gains tax. Another good thing to note about QSBS is it only applies to shares that are held by the original holder. So one of the situations we see founders get into quite a bit is issuing themselves too many shares and then realizing later that they need a co-founder. And if they don't have anybody by their side that can tell them differently, they say, oh, I'll just transfer some of my shares to that person. Well, guess what? Now that person has QSBS blown for their shares. Or we see founding teams try to reshuffle by repurchasing a large amount of the company's equity and then redistributing it. And that can trigger redemption, disqualification for QSBS, which can blow it for the whole company. And now, guess what? Your future investors are super bummed and maybe not going to invest in your company.
So what I'm hearing is there are a lot of dragons.
There are a lot of dragons. If you try to get fancy, like your responsibility is to think about who you're distributing equity to and put it on a reasonable vesting schedule and don't do something crazy and you should be good.
Yeah. How are we doing on level of detail? Is this too deep where I'm seeing some thumbs up? Okay. All right. So we're about halfway through. I've got a few more questions that I can ask, but based on what we've talked about so far, I'd love to take a couple questions if I can. Kind of keep the questions short, maybe 30 seconds to a minute. I saw your hand first, so I'll let you ask.
This is probably a really stupid question, but is there some type of legal Zoom for founders that just covers all this stuff?
There are a few. We build one. There's also Carta. I have a complicated relationship with them. But no, there's a ton now, and they're finally coming to market and maturing. There's Pulley for Cap Table, which has like a great employee focus. Carta has been, lawyer-led and is now trickling down to earlier stage. AngelList moved into the space a few years ago. Gust is in the space. There's a whole bunch of options that are good. We think we're the best, but that's up to you.
And please just use one. Spreadsheet managed cap tables are a nightmare. Use something. And Pulley's like $1,000 or $2,000 a year. Carta starts at $5K. I don't know what you start at.
Well, Carta you can get for free if you raised under $1 million, but you have to do it yourself and bring all your own templates, which means, guess what? You're paying a lawyer for that. But there are a whole bunch of reasonably priced ones. But yes, don't use a spreadsheet. Go get some cap table software and find somebody to help you use it. It is worth it.
I can vouch for Gust Launch and Gust Mission Control as a customer. They're excellent. I wondered if you could
We
expound.
didn't plant people, promise.
I totally on my own volition. Can you expound upon why a Delaware C corporation is preferable and why having a larger number of shares is preferable? So we started out with Gust as a Delaware C Corp with only 2,000 shares. Through them, we've amended to 10 million shares. And I just wondered if you could expound upon the wisdom behind that move.
Sure. So the Delaware C Corp question is a really interesting one. Fundamentally, it's in two parts. So a corporation is automatically split up into shares by its nature, which means it's already set up for ownership, whereby an LLC, you can grant profit interests and ownership interests, but the structure isn't baked into the governance of the entity. So a corporation generally is a good structure to get a whole bunch of people involved in building a shared enterprise. And then there's the Delaware question, and the answer there is a little bit more nuanced because a whole bunch of people have a very similar corporate code to Delaware. Right? It's just laws on the books, but Delaware has a huge body of precedent that has been set because so many companies, they worked hard to get companies to incorporate there, and the Delaware Court of Chancery has tried all of the business cases in the world. So people look at it, and not only do they see the letter of the law, but they understand how the law is going to be applied in Delaware because of all the precedent. And the large number is because you need a large number of people involved in this. And it does have some implication on your Delaware franchise tax bill, which is going to look really scary in the first year anyway. But the reason that you have 10 million standard is because you can grant relatively small grants of equity that vest over relatively long periods of time without having to divide 5 shares over 8 years in some way that is fractional.
Just as a little fun one for you, one of the companies I was part of had, I think, 300 million shares issued with the Series A. And at the time, the chairman was like, well, we like to be able to give millions of options to a new employee. Like, it was just optics. We never really understood it, like in terms of a good practice, but people do a lot of strange things with those numbers because they're kind of fungible. At the end of the day, it's just how many are outstanding.
But to highlight your point on the divisibility, right? You mentioned the vesting schedule, the 1 and 4. So 25% are going to vest after 12 months, and then 1/48 of those shares typically are going to vest every month. So 1/48 of 15 shares. It's pretty hard to do, but if you have 10 million shares, that grant is going to be ultimately more divisible. So that's why you grant more than, you go from 2,000 to 10 million instead. So the visibility. I don't know if that was exactly clear, but.
Hey, thanks, guys. Quick question. So, like, working with a co-founder, we're kind of in an early discovery phase, doing prototypes, some early customer interviews. When is the right time to like broach this topic and get a founders agreement in place, or go to Gust and sign up? Like, when do you advise your startups that before I come pitch you guys, should I kind of have an idea of that already worked out?
From the earliest stage, we often are investing in the first round where a company will go incorporate. As part of that, the lawyers will just spin up an entity. I think there's kind of the deeper question here is, when do you talk about what does co-ownership mean? And I think of this as like roles, responsibilities, which often are a big chunk of it, that then move into, and how should we divvy up the business? And so these are three things that I think kind of go together. Sometimes I meet teams that have said, oh, we're going to equal split, before they've talked about roles and responsibilities or whatever it is. I think having a clear understanding of what you're each bringing to the table and having an honest assessment of how many decades will it take to build the company, and think in decades, don't think in years or months, and ask, great, what are we going to fight over 22 years from now, and like, do you want it to be 3% or 4%, or do you want it to be, something much bigger? And so it's very controversial, I think, take maybe in some parts of the US, but for me, I'm always equal split across all co-founders, because then you're arguing hopefully about things that matter more. But really, roles and responsibilities, when you're just talking about that and feeling like you have something that could go, bring in outside capital, or you want to put money into, that's when I think it starts to make sense to ask, and how would we divvy up the business?
Yeah, I feel like that is pretty much a perfect answer. The key is to have the conversation, whether you do that through a co-founders agreement, which forces you to answer those questions and write them down and put them in like a pseudo-legal thing, or whether you just have the conversation. Understanding what everybody is expected to bring to the table, and having that have some bearing on their equity is a really good idea. Because if you don't have that conversation and you're looking at the equity cliff, you have nothing to evaluate whether or not things are going as planned, and you have no expectations to work from. We actually advocate for a slightly different take on that. We build a tool where you can go through, it's basically a collaborative founders agreement. It's free, it's at cofounders.gust.com. You go through, enter all your team members, say what they're going to contribute, what their role is going to be, what their capital contribution is. It spits out a suggested equity split, and then you can send it to them so they can go through and you can compare notes, right? So we don't typically advocate for splitting equally, because that has some interesting governance outcomes, but I think the other opinion is completely valid in that it doesn't really matter as long as you have the conversation. But we're a tools company, so.
So I'll go with, it's never too early to have a conversation and get something in writing. You don't have to hire anybody, you don't have to pay money for it. Have a conversation and then summarize it between the two of you in writing. Because we don't agree on everything, I am very against a 50-50 split between two co-founders unless you have a written agreement on how a disagreement is going to be settled in the end. Because bottom line is, you're both here for that third entity, which is the company. So if there is an absolute just hard stop on both sides, and you don't have any governance that allows for that agreement or that discussion to be solved, then you can be in a world of hurt. So I love the idea of having some form of, if it is equal ownership, there has to be some type of governance, that supersedes that in the end. Because bottom line is, you and your co-founder, Brian and I are really lucky. I'm very lucky that I had a partner like him, and we had a great partnership for 13 years. I've had other partners that didn't go so well. And so, it's just like any relationship, there's going to be troubles. Right now is probably, some of the happier times, because you haven't really hit the hard stuff yet, even though this is really hard. There's just going to be hard stuff that are external factors that you're not going to be able to control. And I would plan for that, just in case. And once again, you don't have to spend money just yet, but have the conversation and get something in writing. Even an email agreement back and forth stands up to some degree.
Yeah, sorry.
Well, I was going to say, one of the best governance I think most companies can do is, you have to figure out when is right, but this is where the board comes in. And if you raise external capital, this will be a forcing function to put something like that in. And for example, at our companies, I always had 2 voting seats on the board, one as chairman and one as co-founder. And so if I was ever removed as CEO, like my chairman spot went away. And if I was ever removed as a founder, my founder spot, they could claw it out of my dead hands. But you know, like I always had 2, my co-founder always had 1, despite us having a equal split of the business. And then we still had independents on the board or shareholder, like preferred equity holders. So you could do boards. I wouldn't do those pre-seed. It's like kind of a little bit of work, but you can have something in place that kind of embodies this.
Yeah, and I think just one question on the when to form. If you're going to go out and raise capital from angels or VCs, largely the expectation is going to be that you're structured as a corporation. You don't necessarily have to do it before you get somebody to sign on, but you should have a plan and you should have an understanding of how long that plan might take. If you're just going to go and form a corporation and you're a single person, like this is easy, 3 to 4 days, you're done. If you have an LLC and maybe you took some money from somebody and you have an important contract, you should start to kind of understand what the timeline of that is going to look like, so it's not an actual blocker to funds coming in.
Thank you, guys. Again, another Gust fan. So I've been using Gust for 4 years, so love it. Thank you. Regarding the 409A valuations and all that stuff. So when is the right time to go for the valuation, and what is the thesis on like the valuation? So is it like just going by the revenue at that point, or like so what are all the things that you consider for a 409A valuation?
So a 409A valuation is a valuation of your common shares, and it is typically undertaken before you start issuing stock options. What it is essentially an arm's length valuation, so it's somebody outside the company making it that gives you some safe harbor from future inspection of that share price. So if you don't undertake an external valuation and you go and issue options, the IRS essentially reserves the right to dispute that in the future. Again, normally this stuff doesn't matter unless things go really well or really bad, or really well then really bad. But it's a fundamental thing that startups will engage in. The biggest confusion point is that people look at a 409A valuation and think it has bearing on the investor-facing valuation, which it doesn't. As Mike said before, like you are selling preferred shares to investors. They have different rights associated with them and protections. They are valued significantly higher until all of that stuff converges at an exit event. So a 409A typically happens before you issue equity. It lasts for 1 year until you have to get it renewed. And then if you have a significant fundraising event or other significant business milestone, a material event, typically you'll go back and get it renewed. And then prior to having an option plan, your board can approve a valuation if you need to adjust the share price for any reason.
And on this, you want the absolute lowest 409A every single time. As much as you want to see that number go up because it's fun, it costs your employees and future hires more money to think about how they exercise. So I remember I had one of our 409s rejected from our board, and I had to go back and basically weasel out of my bullishness on my own business to like say, like, oh, maybe it wasn't as good as I thought it was, but because you go through a whole thing and fill out forms to do your 409A. Long story short, you just really want that number to stay as low as possible because that's what gives a low entry point for someone to early exercise. And it has no bearing until you sell, and it may not even have a bearing in the sale.
And in terms of how it's determined, it really depends on what your business looks like. If you have revenue that is, sustained over the past couple years, that will be a factor, and there will be a discounted cash flow analysis that's done based on your actual numbers. But typically, a 409A firm, and it's changing all the time, so this is knowledge from 2 years ago when I was close to one. But in addition to discounted cash flow, they'll look at market comparables and things like that, and they'll usually pull in, have a quiver of potential valuation methodologies, and they'll choose two based on the information available, and then they'll extrapolate between the two, and usually do like a top-down and bottom-up, and then justify it that way.
And if you're pre-Series B, it almost always is just your last valuation that you agreed on with your investors if you're raising capital. So it somehow always comes back to something very close to like the cash you just raised or total capital raised.
So to that point, when you raise funds later on, a later A series or a B series, That's a really good, right post that transaction is a really good time to reward your employees that are staying with you, because those are going to be, a penny or less. So it's a really good time because it's at a transaction. If there's a preference to the other, to the preferred shares, even if you're transacting at 25 million, if there's a 1x preference to the preferred shareholders, then the whole 25 million would make common shares worth 0. So it's a really good time to load up employees that are sticking with you with options that are at a very low price.
Thanks, guys. I'm wondering if we could tease out a little bit further the tension between prudence of stewarding well and also generosity when it comes to providing equity for your first few employees.
Man, he's coming with the hard ones now. Jeez.
I know that was deep, so I'm going to let you.
I just say for an employee, anything over 1%, approach with scrutiny. For an advisor, anything over 0, approach with scrutiny.
Yeah, agreed. But keep in mind too, you don't want to be stingy, and it depends on the necessity of the person. If you have no revenue and you're approaching a technical concept and you need a first technical hire, then you're likely looking at a co-founder. And if you try to give that person, 0.7% of equity, but they're absolutely critical and it's not going anywhere, then you're going to need to adjust your expectations. And in all of this, like, your ability to advocate for less equity is always based on your ability to execute and your past execution. So if you have great traction and you obviously have a team ready to go and knock this thing out of the park, then you're in a different situation. But you want people to be incentivized to build this like big shared enterprise with you, and you have vesting to help you protect that over the course of time.
I want to give an example. I like examples just because there's a lot of theoretical stuff out there. And one of the things that we recently did, we brought on a technical co-founder to one of the companies we invested in, and we wanted to issue this person about 8 to 10% on paper. And I mentioned this earlier, tranching. I think it's something that's not used enough. Essentially what we did with this person was we had 4 grants, 4 years each, and each grant was in the contract. Each grant was issued on the calendar year anniversary. So the first grant of 2.5% was when they joined. In the second year, they got another grant as long as they were gainfully employed there for 2.5%, which started a new 4-year vest. And so when you look at it like on a long scale, they'd get their 10% issued, at the point of time, obviously subject to the dilutions, but they'd really have 4 grants where the last grant would be, I think, vesting in year 7 or 8, right, from when it was issued. This gives you an incredible amount of optionality, because not only do you have each year you have a cliff against one of the grants, but you kind of have this bigger, not clawback, but bigger exit point to say, did we make a mistake issuing just this much to this person? And so you could be 2 years in, and they're halfway through 2.5%, but they've only just hit the cliff of the next 2.5, but there's now an entire 5% that's never even been granted. And so tranching, I think, is really not used enough, and it helps you hedge while still putting some affordance in place for someone to feel like they're getting a meaningful chunk, and they need to work for it. The hard thing is you go, and we had a company where a co-founder left, and they left with, it was 25% of the company. And the company pivoted, and this is another thing. Sometimes your ideas change, and your team changes, and you have a choice of, do I shut down and restart, or did enough of this intellectual property get built at my company that I'm doing right by my investors to pivot and not shut down? And that one co-founder just doesn't work out. Well, in that case, they'd leave with a lot, and you just kind of get stuck in the ocean at that point. You got a heavy boat. So, like I said, above a certain threshold, scrutiny is important. Tranching is great. Call me anytime about it. I love it.
I love that advice. That was really good in the sense of tranching. But I think that the part that I loved about that advice the most is you're not going to be able to solve for every single scenario that could possibly happen. So talking to people that have done it before, either professionals, paid professionals, people that are willing to mentor and talk to you about it, it's so important to get like those stories out, those examples out, just to hear it and say, oh man, that would be really terrible. Once again, Brian and I were very fortunate to be together for 13 years, but that's not always the case. So plan for that.
So on the other hand, when you guys invest in companies, right, do you see any correlation between the founders or teams that get this right when they come to you versus their overall success? So, tangible example, somebody here has gotten all this stuff right. Are you more likely to invest in them? Is it more likely for them to be successful?
I mean, my take is I don't spend it. I actually do look at cap tables if they're already present. So if we're investing in seed after a pre-seed or a Series A, which we do Series A's out of one of the funds I work with, I will dig into the cap table to try to predict out what misalignments might we have. But it's often more from the perspective of they did everything right. Do they have enough juice to squeeze still? So like if we're doing a Series A and the founder has 10%, they're just not going to make it. They don't have enough equity. So we now know as investors, we're going to need to, issue another 20, 30% of this business back to the employees to have enough juice for them to go another 10, 15 years. So traditional, like for me, it's less about the interrelationship of co-founders getting it right. I'm often just looking, is there still enough juice to squeeze in the company? And it's just really hard to know early days from a cap table. You almost always can tell just by how the co-founders talk in the pitches. You can almost always just see, how they engage. And it's why I think second-time pair co-founders have such an easier time because they've been through it. First-timers, I think, really have to show how are they going to handle adversity. And, to some of the points made earlier, you can't predict all these things. So to me, that I pay more attention than a cap table. But often the ones who have that better have cleaner cap tables. So it's kind of if it's coming down to the cap table, it's not great. If it's coming down to who owns what percentage, it's not great.
Yeah, and to your point, I don't think it's a strike against the entrepreneur if they didn't get this perfectly right, because if you're definitely a first timer, you're concentrating on building this business and attacking this idea. You don't know about cap tables, so you could get these things wrong, but there could be a hindrance if it's really wrong and not able to be fixed. Many times in the rounds of funding, even early on, you can restructure those things, but it can be difficult. But I don't think I would knock the entrepreneur, but it could be difficult to invest if the cap table is really off. Right?
It's like finding a pressure point. You push on it a little bit to kind of figure out, hey, is this an issue or not?
So I'm hearing you say this might create some inertia, but it's not the thing. I would say if you're not finding product market fit, none of this is going to matter, right?
Traction trumps most, right? But
Yeah.
most things can be fixed. But then depending on the funding stage too, you have to think about what percentage of the capital invested in is going to go to fixing, right? If you have to re-incentivize a founder upwards of another 10%, that's effectively coming out of somebody's portion, right?
It's coming out of the investors.
Right. So then your calculus is different, right? Okay, pre-money valuation is going down, or it's staying the same and we'll own less. Like, where is that coming from, and is it worth it? Or, how much legal work do we need to do to invest the first $250K into this company? If it's $50K in billable hours, that's not an attractive proposition for where the capital is going to go. But if the traction is there and the company is exploding, everything can be fixed with enough money. You just want to make sure that equation is right.
I think for me, and just how I've been fortunate enough to pick investors and work with investors, my favorite ones and the ones that I've been with through multiple companies, they'll help you solve this. If they are aligned with you and they see value in the business and they believe you, in what you're doing, they're gonna figure this out. And I'm not a full-time investor, so I can't say that's what we do, but the ones I work with, and when I have issues with seed investments and I send them to some of the investors that are the bigger guys and gals to fix this, just remember that they're seeing 100, 200, 300 deals a year. They're writing 10, 15 checks a year, or 5 if they're big checks. As founders, we do one company every 5 to 10 years. But they literally by default become experts in seeing all this kind of nonsense. And so they know all the different ways. Like, we've brought on co-founder. I brought on my co-founder into my last company, and I gave him half my stock, not through transference, but diluting myself. And I just issued him all new stuff, which made it very expensive. We were already worth $20 million at that point. We then had to figure out how to help him early exercise. We then found a crafty way of doing loans with recourse, and I had all my investors helping us, and our board worked on this, and it cost us a couple $100K, but it was very meaningful long term. And so there are ways of solving these things, but you have to have momentum, because otherwise you're kind of spending money for not a good reason.
So I had a question about tranching. I'm actually very curious about this because me and my co-founder considered doing that in anticipation of a potential future co-founder. So how do you handle pre-exercise when you're tranching? Do you do it all in a vesting schedule, custom vesting schedule for each tranche, or do you actually have the grant come later?
The grant comes later. So they can only early exercise the first grant. So each year they're going to have to do an early exercise. And what may happen is that by the third or fourth grant, they're just not going to bother because valuations have shifted. But they are separate grants, yeah. There probably are other ways of structuring the grants. I just always kept it simple because these should not be the norm of how you're issuing. These are for situations where you're bringing on someone that's going to be very material to the business, so I wouldn't be doing those normally.
Yeah, and just remember, if this is for a founder at the initial point, the first grants are probably going to be restricted common stock, and the later grants based on the escalation of the valuation are probably going to be stock options. So just keep in mind that that shift will likely happen through the tranche somewhere.
I think we got time for 2 more questions. I want to get this guy and then you.
Any guidelines on how much of the company to include for pre-revenue investments?
Well, I think I get it. Yes. You said how much of the company to set aside for pre-revenue investments? Yes. Okay. So another common misconception. When you form your company, you're going to have authorized common stock. You are setting aside none of that for investments because investors, by and large, don't buy common stock. At the earliest stages, they may transact through a safe or convertible note, which is a promise for future equity. And then when you do start to actually sell equity, you're not going to issue that out of common. You're going to create a new share class in conjunction with that round to accommodate those investors. The number of shares and the price is going to be based on the negotiated valuation, and you will then have common stock and, for example, Series A preferred, maybe 1, 2, 3, 4, 5. But
thank you, guys. This is a much broader question about, I guess, the startup world in general. I feel like the financial landscape is very evolutionary in today's world. We see a lot of decentralization, and I think, especially like within equity, there'll be a lot of fractionalization and like increased liquidity for different people. And do you guys see that like changing the startup world? Do you see the startup world sort of evolving to meet the like evolutionary financial realm?
yes, I hope so. Personally, I've been surprised, as I guess startup people are, at how slowly that shift has actually happened. And I think it's actually going to be quite a long time. With the Web3 and blockchain stuff, you saw a whole bunch of people try to do this. Obviously, there's a whole bunch of securities regulation around it, and it's difficult to solve, but people are finding ways to solve it. But I think it's going to take a lot longer than I would hope to get to the future where all of us can work on like 10 startups and have fractional ownership in each and have that be liquid in 4 years. That's the world I want, but we're still quite a ways from it.
I interpreted that question a little differently, which was, why is it so hard to sell stock you have in a company? And why are these things called secondaries so difficult? And we are seeing a shift right now. There's actually, on the LinkedIn, Twitter, X, whatever it's called, on the internets right now, there's a big battle right now because IPOs and liquidity have slowed down. And you have all these employees who work at companies who financially can't afford to leave because they might have a tax bill of $400,000, $500,000, $600,000 despite not having a realized gain. So it's like in paper they're worth a bunch, but if they leave and they have to exercise their stock, they'll have to pay it. And in 2020, 2017 to 2020, 2021, there were plenty of companies that would loan you money to exercise your stock from a cool tech company. And what they would do is say, oh, I'll take 10% of your holdings in return for loaning you the money to exercise. Well, they've dried up. They're not as interested because IPOs have slowed down and public valuations have slashed. And so there is a burgeoning market right now around secondaries. And traditionally, they had been done by groups like Forge and equity zen and stuff, but we're starting to see more and more kind of bespoke small players come out, like Hive, Hive. We invested in one called Augment Market, where they're helping employees put up, 10 basis points, right, what they have vested up on the market to be purchased by another individual retail investor or accredited investor. So I think that's happening right now. There's a lot of fighting against it. And, the big reason is because a lot of big investors don't want the stock of companies they've invested in circulating on the open market. And so I got a term sheet yesterday that actually forbids it altogether. And so this is a common strategy amongst your top best funds. They don't want their companies bought and sold that way, but it's happening. Whether, founders, I think, will increasingly look at finding investors who are okay with not having protective provisions that allow their employees to sell a little chunk each year. And my theory on this is that more and more mid to late stage startups are going to have to figure out how to offer liquidity to options as a means of compensation to compete with the big players. Because if you're Google, you're paying your average senior software engineer between $400,000 and $600,000 a year with stock and base comp. If you're a startup, let's say you're Canva, a billion-dollar company, but you may not, pick one that like Rubrik prior to IPOing, you're paying your engineers $200K. That $400K delta is a really big delta. But they've got that value just locked up in options or even exercise stock. And so I think we will start to see more and more secondary in a streamlined way where, CEOs and boards basically say you're allowed to sell up to 10% of your holdings every year without going through this archaic process called the ROFR, or the right of first refusal, which gives a board and preferred investors 90 days or more to slow your sale down while they decide if they want to buy it first. So anyways, a lot of cool stuff is going on there. Don't think decentralization, like from technology blockchain stuff, will impact it, but there is a lot of really cool stuff going on right now fighting the big dogs to allow employees to sell secondaries, because I think it's the biggest issue in employee compensation for startups. Is the only way to sell today is to maintain a really close friendship with the CEO. And that creates all kinds of problems.
Yeah, and I think we've seen it actually evolve pretty well. Like companies like Stripe were doing this on a regular basis through tender
buyback
offers.
Programs, yeah.
Yeah, and allowing this liquidity to happen because there are just whales of companies that aren't going public. So that piece of it is definitely happening and evolving and bringing some liquidity. Hopefully we'll get to market liquidity. Yeah. No, that might get really weird and scary.
Well, it's super common in public. Apple's doing, what is it, $100 billion buyback or something.
Yeah.
I mean, private companies, big ones will do it because they're sitting on cash. But the only time you can really do it is during a financing round, because that's when you have an active buyer. Outside of that, it gets a little trickier. But that's how I want to interpret your question, because that's what I want.
Well, I think it's a good interpretation. There's one other interesting point to this, is that early on, before a company's stable, if you have shares selling on an open market, it establishes a market price for a startup that is right now able to go 18 months before its valuation is inspected by the external market. And changing those dynamics changes quite a bit about startup fundraising and how it's done. So that's why until a company is essentially like a multi-billion-dollar stable Series D through F company that can do structured secondaries, there's a less appetite for that early on.
There's a lot of dragons once again. I think one of the things I'm taking away from, and having done this for 20 years, and hearing, what the questions that are being asked and the answers that are given, I think the one thing I would take away from this is that this stuff really, really matters when that third entity, being the company, is doing really, really well, right? And you want to solve for these things, get really good advice, mentors or paid, otherwise, it doesn't matter, but like get good advice and really think through these things, because when things do go well, you don't want something coming up and just snapping your joy from the things that you're toiling so hard for. Brian and I, once again, he gets none of the blame. We signed a pretty shit deal, in the beginning, and it really hurt, our exit personally. The company was able to survive, but so if this third entity, being the company that you're really working your asses off to make it work well, solving for these things now and using companies like Gus and using good attorneys, good CPAs, and mentors is really, really key for when it does go well, you can actually enjoy it to its fullest.
All right, thank you, all of you, for coming. I really appreciate that. The three of you, this felt like was a course. I learned a whole bunch in the last hour, and I'll be decompressing for the next week. But I appreciate you showing up today and taking the time to answer these questions. All of you had really great questions. I appreciate that. Give me a round of applause. Thank you to the EC for hosting today. I really appreciate that. Hey, Zap, do you want to add anything?
No, thank you for being here.
Cool, dismissed. Thank you.